that works pretty well.
You get the lights?
Yes.
Degree came in handy.
So, this is the crew. I don't think I've ever shown you pictures of them all before. If you visited the office, you see them. Dawn, I got from the ski slopes of Alpine Meadows. She just passed her CPA exam 2 days ago. So
Wow.
that
And
was,
that's why she's so happy in the
she's
photograph.
very, very happy.
Yeah.
You can feel the grin off her
She
face.
doesn't know what she's in for.
No, well, she's worked for me since February, so she's had to deal with me for 10 months, so she figures that out. So we are we're a team, and we are an accounting firm. So we should probably start with something simple. What does a CPA do? And the simplest description, I got this from someone else actually, is that we organize you for success. That came from actually the dating world. Turned out it was a really bad idea to sit down and say, what do you do? I'm an accountant. We're done now. I organize people for success. That worked out better. So, that doesn't mean necessarily sorting and counting of receipts all the time, but it is the sorting and counting of resources. Any kind of business has certain resources. One that Jim's always talking about is time as a resource. There's money. There's also labor hours, how you staff any kind of exercise, how much of your labor hours you actually have, the technology resources. So part of what we're usually trying to do with people is figure out how we can account for all of them. And that's really what accounting is about. Accounting is about trying to create a record of all the inputs. And the easiest one to track is usually money. And we usually assign some dollar value to other things like labor costs and things like that so that you have comparison values. But that's really the core of accounting. Where it comes from is creating a system that organizes and captures everything that you were doing and puts it into a lovely document so that you can compare. Some of those documents are very standardized, balance sheets, income statements, and some are very unique to the individual business, production reports, and things like that. Bookkeeping is a piece of that. We don't do bookkeeping of our firm ourselves because I always recommend someone outsource that to someone that actually will visit you every week or every other week for a couple or 3 hours a week, and will do that work for you, freeing up your time to do it. Because bookkeeping is always that task that you will do last, which means never. So,
That's last minute.
last minute.
Just even spell it.
And then what you're doing then is you're creating a memorialization of what you pretty much have pieces of for the last year and cannot use that information for pretty much anything except comparing it to even older information. Bookkeeping is really about giving you timely information so that you can run your business. So you need to then say it's not just about recording things, it's about recording things and then seeing which items we want to track so that we can make the decisions. Do I need to go see someone about getting a line of credit because we're going to pick up a large job and we're going to run short on cash? Do we need to hire someone? Can we hire someone? Do I need to start cutting hours? These are all timely decisions. And if you do all the information at the end of the year, it's too late to make any changes. So doing it concurrently and then implementing it into your process is really what bookkeeping is about. Internal control is about not losing the money. I've had lots of bookkeepers that I've referred out, and fortunately none of them have ever gone to jail for stealing money. But I've also had lots of clients come in and say my bookkeeper was stealing money, just not what I referred out. So typically that was a failure in control. So you'll keep maintaining internal control so that you can have people so that they feel that they're supervised and that causes them to not want to steal money, or if they do, you detect it before it becomes a really big number. So that's when internal control is. All of this funnels down into strategic decisions. You know, do we rent the larger space? Do we go for the larger rent? Do we hire people? Many of these things are driven by the marketing plan. And then we're trying to figure out what's the rest of the pieces that will make that up. If you want to achieve the dream, here's some of the things that we need to have in place, and how do we track to get there. So, and then we do compliance, which is reporting for property taxes and income tax returns. So that's what a CPA does. When a new business comes into me, we usually go through a lot of discussion on most of these points, what kind of business entity is a good idea? And I send them to Jeremy and say form them. Making sure that they have licenses and that they have some structure of bookkeeping up front. Obviously, reporting is always fun. Income taxes, everyone's always remembered, and if you have employees, you do payroll taxes. Large cash transactions, that's the $10,000 rule. Someone decides, I'm going to buy your services and all I have is cash. Take the stuffle bag. There's a form for that, just like a bank. Business property is when you've got business property and the county taxes it, just like they tax your car every year. 1099 reporting for your contractors, sales tax if you're dealing with tangible goods, foreign activity if you have foreign bank accounts, estimated tax so that you don't owe too much money at the end of the year, and withholding. So we walk people through all of those rules, guide them through that. I don't sell insurance, but I do ask if they have it, because I've had too many clients experience losses that were uninsured. So we usually review the list and say, talk to someone about insurance. But these are some things to really think about. Bonding, sometimes you've got employees handling cash. Health insurance is now a mandate, and they decided that the accountants should run the system. I don't know if that's a great idea, but nevertheless, that's what we're doing. So we have to report all the health insurance. So this year, everyone will give me a health insurance form. I will have to find it for them. Errors and omissions, directors and officers, if you've got a larger organization. Cash flow planning is always the biggest part of any business. If you run out of cash, you're out of business. In most businesses, you only run out of business 2 or 3 ways. Running out of cash, running out of inventory. Those are always 2 really big ones. So it's always amazing how many places cash leaks out. That can be your cell phone. It's amazing how much money you can save just walking into the AT&T store every 3 to 5 months. They always have a new plan and it can save you more money. So finding all the leaks, evaluating where cash is going, and the timing of cash is a part of the business. So one of the things we do try and encourage with our clients, this is not a standard form, but this is a model of what one might look like, is a weekly cash flow projection. I've had a lot of clients save a lot of time by not having to look at their bank every couple of days, just to see if there was cash in it. And the reason is because they're always chasing down cash because they're going check to check. And by pushing out a projection, you can actually get ahead of that, which saves you a lot of time and energy, because you actually burn a lot of your mental energy trying to do that. And if you then have some warning about, okay, 3 weeks from now, I've got a cash flow problem. Who are the clients that I've got to talk to or I'm relying on? This is a simplified version. What you would actually do for cash receipts is break out who you're expecting to pay you, if you actually have individual customers, or if you have just a business, then you're looking at sales variances and, if like a restaurant, or if you have something where people are paying you every week, what are the timings of all those cashes coming in? And how much cash do you need to basically have as a safety level so that you can make it through the rough patches? And then you look into lines of credit and things like that. So we help people set things like this up. And it should be weekly. A lot of computer systems will just give you a monthly kick out. Monthly is great, but the roller coaster ride is in between the month, really, really painful. So what we like to do is do weekly. You can do daily. Most businesses, daily is excessive because there's too many things that change one day to the next. But sometimes you've got to look at it daily just to get things right. Usually weekly is a generally good focus. Generally you want 4 to 6 weeks. You want to be able to actually accurately predict your cash 4 to 6 weeks out. So we like to test that and say, okay, where are we 3 weeks later? Are we right? Are we wrong? What was wrong? What were the errors? Sometimes there's just hopeful and what we might call enthusiastic optimism about when people will actually pay you. And that's what happens. So measuring that helps you dial it back in and give you a much more real picture of how cash flows. So cash flow planning, big piece. Capacity planning. business coach here was just talking about, it's possible to grow 50%. It is. I grew 43% this year. It was really painful. Because I was stripped, my capacity limits hit at about 35%. And after that, I started working every weekend. So I have to fix that. But part of that is how much cash do you need to grow? Because as you grow, problems that were small and totally manageable grow with you, and then they break down. So there's a little rule of business: every time you triple, everything breaks. So when you had 3 employees, then your payroll system's broken. Then when it goes up to 10 again, it breaks again. When it goes to 30, it breaks again. So same thing happens with customers, happens with volume. Little problems that didn't really matter or were too small, it took up 5 minutes of your time, now take 3 hours of your time. Or cripple something. An internet page that doesn't go to the right thing, or requires some manual entry of yours that initially was too small, but now it's 4 times bigger and it takes a lot of time. These are all the things that sort of come up. How much equipment, changing equipment out, what's the real limits of your equipment? This schedule here is actually for a bread oven. Doesn't look like one, but it's what it's for. And there are actually 6 pieces of equipment here. The idea being how much was the maximum throughput, and what was the client at the time was convinced that they were at their limit with everything. The batches, everything was all full, and it took them hours and hours to get it all through. So we ran some numbers. What we used, instead of say dollars, we used minutes. And so everything ran in minutes. So after a fair amount of measuring, figured out what the right unit of time was, and measured it all out and looked and said, you're actually using 15,300 units of time. And the units of time where they came from was the amount of time and the amount of space that was occupied in the proofer system and the oven system, the baking. So we calculated how that unit would look so we could see what the real maximum was. And they were at like 60% of their maximum, meaning that they could grow another, almost double. Not really, but about nearly double. And everything would still work. So the flaw was not in the equipment itself. Don't buy any more equipment. Change the flow of how everything was going. Once they saw that, they could see how to change the flow. But they were convinced it was the equipment to begin with. So, and this was how it calculates. How many oven units existed per half hour, running 80 pans of bread. It was great fun. So capacity planning is great fun. And then we also do tax returns. Right now, of course, we're doing tax planning because it's December. We're trying to help everyone get through. Most people did better this year than last year, which means that last year, when they didn't owe any taxes, they can now expect to owe tax. So what can we do to fix that before the year ends? Bonuses to employees is always fun. Sometimes we can time tax payments out to states so that you get the tax deduction this year. Everyone says, okay, should I go buy a truck? Sometimes you should lease a truck. So we go through a buy lease analysis in terms of what makes the most sense from mathematical. There's no silver bullets in that. I, for example, like to hold any vehicle I have for 10 or 15 years. So lease is always a bad idea for me because I'm going to win on the owning. Other people I know beat the crap out of their vehicles, so they love turning in the keys every 2 years. And their mileage range is short enough that it makes sense. So lease is almost always good for them. And for everyone else, it varies in between. So all this comes down to what you want. Being on a border town, we always have a lot of multi-state activities, California versus Nevada versus Arizona versus Oregon versus Hawaii. Those are the most common states we usually run into. But I've got clients over creation now. So that always creates fun with sales tax opportunities. Whether there are activity limitations, do people need logs? This time of year, I'm usually calling people up and saying, you have a corporation, you should probably talk to someone like Jeremy about doing minutes. Don't talk to me because I don't do minutes. It's always good if you're in compliance with a corporation. We do look at audit risk. Audit risk, in truth is really low, but there's lots of ways that you can just bring yourself to the front of the line. So we look at some of those things. And then, of course, maybe other areas we like to play with. Gift and estate tax, those lovely languages, that lovely language underneath there, grats, idiots, islets, CRTs, and CRUTs. Those are just fun estate planning tools that come up fairly often. Grats are ways to transfer assets to kids while you're still alive, so you can avoid tax. Intentionally defective grantor trust is what an idiot is. Islets are life insurance trusts, charitable remainder trusts. We come up with a bunch of fun techniques, and then I get to send them to the lawyers to actually write the paperwork. So, since we talked about taxes, let's talk a little bit about what the government is going to be doing soon. So, the budget deficit has been going down. We were at $1.3 trillion. That was the point that everyone was saying, well, I can't see how we could possibly cut another dollar. We all said that was insane, but nevertheless, that's how everyone was operating. They decided, well, we're just going to play a game of political chicken called sequestration. We'll create a plan that's just that cuts all of the spending so badly that none of us will want to do that, and we'll come up with a better plan. And they didn't come up with a better plan, so they ended up just going through sequestration. And created some interesting things like defunding Homeland Security, probably was a bad idea. So, dropped down to $681 billion by 2013, 483, and we weren't actually supposed to get it, but the numbers just came out. So 2015, the deficit was $439 billion, and the national debt is currently standing at about $18.1 trillion. About $5 trillion of which we generated since 2001. So that's our current standing. So the government is feeling a little less pressure because we've operated with $200 and $300 billion deficits for years. It's not a good thing, but nevertheless, they feel less pressure. So they're starting to back off a little bit, I think, on some of the tax pressure. But the news isn't going to stay good. Part of the reason the 2015 numbers came out well is because the tax receipts are up by 8%. Everyone's doing better, or at least enough other people are doing better now than they were 2 years ago than they were projecting to. And government, because they have done nothing but fight, can't spend any money. So outlays are only up by 5%. But we're starting to see them organize themselves into spending money again. So they're probably going to. So Congressional Budget Office still expects the deficit is expected to widen, be $1 trillion in 2025. So we are still going to be seeing no new tax breaks coming up. Regardless of who's in control, everyone says if you're going to create a tax break, you're going to have to pay for it. And we have to pay for it either by increasing taxes somewhere else or reducing spending somewhere else. Some of the outlays, because they're only at 5%, because military spending is down 4% because of Afghanistan, probably won't recur now that we have ISIS. So we have still a lot of pressure, still a lot of money, but no longer the panic to raise taxes that was present a couple years back. So we expect a more gradual increase in the rates over the next few years as we go. And other than that, any questions?
Do you specialize in certain business types?
So, like most small and medium-sized businesses, once business gets much over $100 million, I'm not going to have the staff to deal with that. So, you're going to be looking at small and medium-sized businesses in general. Don't do farms because that's a very specialized industry with lots of subsidies and such. The closest I'll do is like a vineyard, because those are not farms, but they're fun to play with. That's about as far as I'll go. Most online businesses and most of the businesses in Tahoe I've played with. So a lot of construction contractors I've played with. Those we played with.
What specific things trigger an audit? I mean, I got audited recently and thankfully I got through it in one piece. And I know in my case I did a lot of travel in 2013, which is what spiked their algorithms, I think.
Yeah.
And it was all legit and I could prove it, but what
It
are some
was,
of the other, because I was convinced, I mean, everything I do is legit. I hadn't been so well organized with my bookkeeping, so it kind of got me in order. But
So travel, meals, and entertainment is always a great way to get yourself on it.
yeah.
Especially, if you have very little income and all of it's in travel and you're in a sort of job class that doesn't have a lot of travel. If you're a traveling salesperson and that's your job classification and you show a lot of travel expense with revenue, it's probably not going to get audited because that makes sense. But if you're a business that they associate with being in an office and yet you've got the travel budget of someone's on the road every day, that is probably going to be something closer to an audit. Because what they're doing is, the audit screening system is basically a computer, and what we sometimes refer to as a frowning face engine. You just see smiling faces and the machine's looking for the frowning. And the way it's doing this is by comparing your percentages to national percentages and then to also what we call research projects. I had one client, she got audited, she was just lucky, it's the third audit she's had in 5 years.
Oh,
This audit, she doesn't even really have a flag, she was just lucky. She was in a business classification that they were doing a research project on, so they pulled her. And she had
What's
a
the
nice...
business? Yeah, wasn't staging, was it?
It was not staging, no, it was not staging. IRS is doing a research project on small business, Schedule C type businesses, so non-incorporated businesses right now. So they're doing a lot of those, and the industry class she happened to be in just was one of the ones that they were pulling. So she just lucked out. The other two audits were deserved. This one was just fun. She wasn't my client until she got audited the third time. She just figured this was probably a good idea switching out. So sometimes you would pick just by job classifications that you track repairs. So I have seen some preparer-generated audits in the past. Not mine, but we have had a couple of preparers in Reno get their licenses revoked, and the IRS show up and seize all the records. So they do track preparers, so there were a couple of clients I got out of that as a result. So sometimes those are the results, but most of the time, it's the frowning face engine and says, okay, you've got really high cost of goods sold for a business of this type, right? If you're showing massive meals and entertainment expenses and you're in the trucking business, probably going to get audited, right? So it's the proportion of certain expenses, and a lot of it's against income. More income solves a lot of problems if we look at it in percentage. Sometimes with some clients I will, especially with meals, because you don't get much for meals anyway, they cut off half of the deduction up front. So with meals we might tone it down just a little bit to make sure it's all valid, but doing an audit is painful.
So you would be able to work with somebody and say, oh, this is, even though it's legit, this is going to spike it, is that what you want? Do you want to tone it down a bit, even though it's...
Well, yeah, because most of the time,
slip it through.
people always come to me and they ask, are you aggressive, are you conservative? And the answer is, it depends on you. Because you don't want someone who wants to be really conservative with someone who's doing something that's really aggressive. My job is actually to match you. Now, of course, there's an upper limit, and where that upper limit does vary from some people to some people, and I think mine is somewhere in the middle-high range, but because much above the middle-high range, then I think you're really just abusing a reporting process. And that's not, there has to be a legitimate basis for the deduction. But I've got some clients that are like, I'm happy to be audited. Okay, we'll do it. There's no problem with that. We just prepare for it. So because you don't get audited now, you get audited 2 years from now. And so from that perspective, we just say, we've got it all set up, and we just put everything in the file because we just expect the audit. That comes up with medical expenses pretty frequently, where someone comes in, they've been perfectly healthy, and now they've got huge medical expenses. And you'll get audited for that. Now, usually it's a correspondence audit. So they send a letter saying, send us a copy of everything. So we just schedule it all out so that 2 years from now, when we get the letter, we can just copy, paste, attach, ship it off. Some things you just plan on. This is going to be an inspected area. we'll get audited, and you document it all up front, and then you don't have to worry about it.
That's when you hand them the shoebox.
Yeah, sometimes it's a shoebox. Sometimes it's a garbage bag.
A couple of topics, you can choose whatever you want to talk about. One is active versus passive income and losses in that strategy. And then the other is, what are some of the common things that you find, like if you get a new client from another accountant, what are some of the things that we could leverage for tax strategy or write off that people haven't in their accounts?
So most of the time, someone comes in, they're in the wrong structure. That's frequently the case. There's a lot of people who are sold a structure up front, not necessarily from the accountant, but from something they saw it on a website. We're in a situation where a lot of people say you should be an LLC all the time. In California, usually this is a bad idea. There's some right choices for LLC. Sometimes just the tax structure is really, really painful in some cases. Other times it's because whatever structure they were put in at the beginning has not been looked at for where they are now. Where they are now is a very different place. I've got a client that we're unwinding. They set themselves up with a structure that's fairly expensive actually to do tax returns on. And because it's just very complicated to do returns. But that was appropriate for what they were planning to do and what they were starting out doing, and it's completely the wrong structure for them today. So oftentimes that's one of the first things that we are changing is what's the right structure for you today? Because maybe and what's it likely going to be for another 3 to 5 years? Because we don't try to solve today's tax problem. We're trying to solve the tax problem over the next 3 to 5 years. But we're trying to structure change. It's too expensive and too difficult to do this back and forth. So that's one of the first things that comes up a lot. Usually there's the next most common thing is typically the bookkeeping system itself. A lot of times, in our profession we call it either the Dilly method or the Sally method. Do it like last year, or same as last year. And sometimes when you've been with one person for a while, that's how the return is actually being done. But the reality is there's actually been changes sometimes to the bookkeeping. It's like a lot of people say that they coded their QuickBooks files so then they tie right into my tax software. I'm like, that's great, I will never do that. Because then that's just causing you to slip into that billing method approach. And so sometimes how things have been reported has actually changed in the QuickBooks file. No one told the accountant, at least not, they're just processes in last year rolling forward. So a lot of times we'll also find the bookkeeping. Those are probably the two biggest areas that we see things to shift in. If someone's changed a number of things rapidly and they have stuff that has a lot of history attached to it, sometimes some of that history is lost every time they change accountants because everyone relies on the computer software to track it, and sometimes the next paid person's the one being looking for it. So that's it. I was answering the first question. Second question
was active versus passive.
Okay, so that can be a little more technical, but the general rule of thumb is an active business is going to be a business that requires you to work your personal labors on in order to generate the income. The passive business being one that you kind of set and forget, right? That's the dream. It doesn't ever work, but that's the dream. All right, so some of those activities, let's say that you decide, you set up a website that automatically sells and ships an educational product, right? This is a perfect passive business, but from a tax perspective, it's an active business. Because you're actually in the trader business of selling something, and that is considered an active business. Now, if you lose money in that business, you can take all of the losses. They're not suspended. Now, other types of passive businesses, like rental activity, those are passive by statute, and you can only deduct what you make. And there's some provisions for some type of people, if you qualify, to take like $25,000 more than what you made as losses. So your losses can get suspended in passive businesses. And if you're in a business that you don't meet the material participation rule for, those can also be suspended. Well, those are usually the hobby law schools.